There's an ETF that over the years has quietly become one of the biggest positions in my entire portfolio. And here's the thing, most people who buy it have no idea what they're actually holding. They think they're buying diversified growth. They're not. I'll show you exactly what I mean. This is SCHG and it's the honest breakdown. Here's what SCHG actually is. The Schwab U.S. Large Cap Growth ETF. Around 200 of the biggest companies in America in one ticker. It tracks the Dow Jones U.S. Large Cap Growth Index, which just means it grabs the largest U.S. growth companies and weighs them by size. Bigger company, bigger slice. That's the easy part. The stuff under the hood is where people get wrecked. And the first thing almost nobody bothers to check is the fee. With most funds, that's exactly where they quietly bleed you. SCHG barely charges anything, about $4 a year for every 10 grand you put in. That's it. Fees are the one thing in investing you actually control, and this one's about as cheap as it gets. That's one of the real reasons I own it. Now, one thing to get straight up front, SCHG is not an income play. The dividend it pays is tiny, under 0.5%. If you're here for cash flow, this is the wrong fund, and I'll tell you what I use that for later. SCHG is about one thing, growth. Okay, here's the part nobody talks about, and it's the most important thing in this whole video. On paper, you own around 200 companies. Sounds diversified, right? It's not, because of how this fund is weighted. The top 10 holdings make up close to 60% of the entire thing. Read that again. 200 stocks and 10 of them drive almost 2/3 of your money. And who are those top 10? Nvidia, Apple, Microsoft, Amazon, Google, Broadcom, Tesla, Meta, AMD. The exact mega cap tech names that you already know. Nearly half the fund is technology, period. So when you buy SCHG, you are not buying a calm, spread out slice of the American economy. You're making a concentrated bet on a handful of giant tech companies with about 190 other stocks riding in the back seat. That's not bad, but you have to know what you're doing. Most people don't. They think the word diversified is protecting them, and it isn't. Now let's talk returns, because this is where people get seduced. Over the past decade, SCHG has put up mid to high teens annualized. That is a phenomenal number. If you'd held it through that stretch, you'd be very happy. But, and this is the part, the highlight reel skip, that return did not come in a straight line. In a single down year, the fund dropped over 1/3 of its value. Top to bottom, more than 30% gone. That's the deal with growth. The same engine that gives you those big up years will absolutely gut punch you in a bad one. If you're gonna own SCHG, you have to be the kind of person who can watch 1/3 of your money evaporate on paper and not sell. Because the people who panic sold at the bottom turned a temporary drop into a permanent loss. The people who held got it all back and then some. I'm not telling you that to scare you off. I'm telling you because if you only look at the up years, you're gonna make an emotional decision at exactly the wrong time. So why do I personally hold this? I think about my portfolio like a barbell. On one end, I've got stability, dividend ETFs like SCHD, boring on purpose, paying me to wait. On the other end, I've got the growth engine. SCHG is that growth engine. As an entrepreneur, I'm already carrying a ton of risk in my businesses, so my portfolio is the counterweight, but I still want a real growth sleeve, and this is it. And here's the personal part that still stings a little. Years back, I owned AMD, I owned Tesla, real positions, and I sold both of them way too early. I left an absurd amount of money on the table because I got impatient and took the quick win. You want to know what's in the top 10 of this fund right now? AMD and Tesla, the two exact stocks I fumbled. So in a weird way, SCHG gave me a second shot at them, except this time they're wrapped inside a fund I've decided I'm simply not going to touch. No watching watching the ticker. No, I'll just take profits real quick. That's the whole point for me. The biggest mistake of my investing life wasn't picking wrong, it was selling wrong. SCHG is partly how I protect myself from my own worst habit. And look, this is what I do. With my situation at my age, I'm closer to 50 than I am to 30, and I'm slowly tilting more of my money towards income as I go. If you're 25, your version of this looks completely different. This is not me telling you what to buy. Quick word on the two funds everybody asks me to compare this to because I get it constantly. VOO is the S&P 500, the whole market, more spread out, bigger dividend, calmer ride. SCHG is the growth slice of that same market, more concentrated, more tech, more volatile, and has beaten VOO over the last decade. Keyword: beaten, past tense. But here's what people get wrong. For me, these aren't in either or. I own both. VOO is the floor, SCHG is the gas pedal. They do different jobs in the same portfolio. QQQ is the other one people throw at me. It's a close cousin to SCHG. It's edged it out historically, but it charges you more than 4 times the fee for a narrower basket of just 100 NASDAQ names. SCHG does basically the same job, broader and cheaper, so that's the one I actually hold. So no, this isn't a menu you pick one off of. If you already own a pile of VOO, stacking SCHG and QQQ on top just means you're tripling down on the same 10 tech stocks. Know what you already own. That's the real decision, not which ticker is best. So who is SCHG actually for? If you've got a long runway, years, not months, you can stomach a big drop without selling, and you want a cheap, simple growth engine, it's a strong core piece. That's why it's in my portfolio. Who should skip it? If you need income now, if you're going to need this money soon, or be honest with yourself, if you're the type who panic sells the second things turn red, this fund will test you, and there's no shame in choosing something calmer. That's the real breakdown, not a pitch, not a this I'll make you rich video, just what I own and why. Real quick, I'm not a financial advisor, and nothing in this video is financial advice. I'm just showing you what I personally own and how I think about it. I'm closer to 50. I run businesses. My situation isn't yours. So do your own research before you buy anything. If you want to see how SCHG actually fits next to everything else I hold, I broke down my whole portfolio down in 3 buckets. Links in the description. Tell me in the comments, are you team SCHG, team VOO, or team QQQ? I read them, and I'll see you in the next one.